Hi, welcome to Search for Yields, the fortnightly newsletter from INR Bonds. I'm Arjun Parthasarathy. And in this edition of Search for Yields, we are going to discuss why bonds are being seen as an asset class that is cheaper than equities and the best asset class to invest in this current market environment. And the reason why we are taking up this topic is because of the fact that there are many market experts, fund managers globally in the macro fund managers, and a lot of content uh, on media about why bonds are cheap now and why bonds make better investments at this point of time than other asset classes, including equities. So let's discuss it and find out whether bonds are actually cheaper than equities. And would you want to invest in bonds, give more allocation to bonds if you're a financial advisor, or uh, not? They go with what the market experts are saying and continue to invest in the way you believe the asset allocation should work. Now, just before that, if you're a financial advisor, clearly the best place for you is INR Bonds Partner Portal, where you can select the best bonds for your clients, give them the best options for investments and fixed income, and also understand whether bonds make more sense than other asset classes for your clients. And with the easiest of investment processes, the INR Bonds Partner Portal makes your fixed income assets grow with your clients. Become a partner, log into INR Bonds and click on Partner Portal and contact us. And if you're an investor looking to, or an advisor looking for a curation of bonds, QuickInvest by INR Bonds, the app on iOS and Android is the best app for you to download and invest in bonds, providing most information, our own risk score, and the easiest of in-app investment processes in bonds. Download the app now.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Coming back to why bonds are seen as cheaper than equities. Now, if you see the last 1 year, there has been a completely sea change in how the markets have taken in how the central banks have started to behave, and also a sea change in how inflation has come to act up. In the last 1 year plus, inflation has reared its head globally. Now, this inflation has not been seen. These are at 4 decades highs, 5 decades highs. So no central banker, no government policy maker, in fact, many of the common folk across the globe have not experienced such high inflation before. It's hitting them hard. And central banks, especially the Fed, the ECB, who have been pumping in tons and tons of money into the market at very cheap interest rates for the last 15 years since the financial crisis happened, 14 to 15 years since the financial crisis happened, are now finding it that the policies which they have loosened into the market have given rise to a Pandora's box, and inflation which hadn't acted up till now is acting up very fast, and they are all getting hugely worried whether this could be a structural problem. Just to give you an example, US and Eurozone inflation touched 10%. And India actually has been much better off. Our CPI inflation has only been highest it touched was closer to 8%, 7.5% to 8%, and it didn't go to 10%. To some extent, RBI has been conservative. Still, they followed the global central banks in keeping rates low, but they didn't really loosen up the money so much, except in the COVID times. So because the central banks are now panicking and they are reacting very fast, US interest rates have gone from close to 0% to 5%. in a matter of a year. And this has actually made bond deals rise very fast. Your 10-year US Treasuries, which was at 1.5%, is now closer to 3.5 to 4%. In fact, they've lost about 20% in value, and many other bonds have lost more as well. Eurozone bonds, some of them long-term bonds, have lost 40 to 50% in value, and all these are government bonds. So clearly, in one sense, the because of the sharp rise in yields on worries of central banks sucking out liquidity and hiking rates very fast, and also market perception is that central banks have not been able to, are not, will be unable to control um, any inflation going forward, because they will be very, very wary of any kind of a policy that can loosen up inflation again. And maybe they're not on top of the things after all. Now, the faith of markets and central banks, if it goes, then it's going to be a big problem for interest rates. So with this, then bond yields have definitely become gone up, and bond prices have gone down. Bonds have become much cheaper than what they were. They were very expensive. But what had happened when bond interest rates were very low? Because interest rates were very low, investors globally went for higher returns and higher risk. So equity valuations went up sharply, and other commodity prices went up, and then you had give raise to currencies like crypto and many other things, many other assets that became very high risk trades, but was seen as a best alternative and giving you better returns than interest rates. And so hence all these went up and went up and went up. There was no check on these for a long time because central banks could continue to pump money into the markets at cheap rates. And suddenly when the whole thing changed, the equities also started to fall. So clearly what the market sees now is that there is a valuation correction in equities because interest rates are no longer low and it's going to stay high for a longer period of time. And if equities, which are giving returns of 12 to 15% per annum, are only going to give you something like 5 to 8% per annum for the next few years because of valuation corrections and other things. And if they have lost, even in 1 year, if they have lost, say, for example, 10 to 12%, the next year they'll have to grow 24% to actually return the 12%. So even if they do 12% in the next year, that means in the over 2-year period, their flat returns have been almost 0%. So given in this, if somebody had invested in bonds, earning, say, in the US Treasury, 1-year Treasury is at 5%, and if you go for corporate bonds, they could be in the US dollar corporate bonds could be in the range of 7 to 8% or 10%. In India, you have GSEC, 10-year GSEC at 7.4%. You have PSU bonds, 3 and 5-year PSU bonds at closer to 8%. You have other corporate bonds in a range of 8 to 10% and higher. Now, would it make sense to earn 8 to 10%, 7.5 to 10%, depending on your risk appetite, annually for the next 2-3 years till equities consolidate? So that is one of the reasons why there is this belief that bonds are cheaper than equities. But having said that, it could also be that bond, because of inflation not coming down, interest rates could still go up. And if interest rates go up, then bonds could, maybe longer term bonds may not deliver as much as expected, or maybe even lose money. And equities, because interest rates continually to go up, can actually lose more money. So maybe both, investors will have to be careful on both asset classes. So the way to look at it in this kind of a scenario is to invest in short-term bonds, 1 to 3 year kind of maturity. Take in the returns that you can get with the safety of money coming back to you in a shorter period of time, or even the possibility of downselling it when other asset classes become much cheaper, including equities. So that is the That is the reason why there is a belief that bonds are cheaper than equities, but financial advisors and investors will have to look at it in totality. So invest in the right maturity bonds, the right amount of safety, and also not fully move away from equities. Maybe look at companies which are fundamentally strong with no debt, because the cost of debt is rising very fast. So interest of costs are going up, have to go up for companies that are hugely indebted or leveraged. And so strong cash flow companies, no debt, high return on capital. Maybe that could be a good complement to a bond portfolio as well. But that's up to the advisor to advise the clients on that. Or if the investors well aware of the fundamentals of investing, then investors make their take their call accordingly. Thank you very much for listening in. Do follow us on our YouTube channel if you're not done so already.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.